You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast. Before we begin, just remind you, make sure to head over to wealthformula.com for lots of resources available to you, free stuff. Everybody likes free stuff, free books and things like that. You can also text if you want a copy of a basic book I wrote on finance. It was an Amazon bestseller. It's called 7 Secrets of Eternal Wealth. And you can also just get that by texting me at 44222 and typing in Wealth Formula, one word. Now, before I move on to the topic today, I also want to point out that sometime this week, you should be getting some information on our next Wealth Formula meetup, which will be in Phoenix, Scottsdale on April 24th and April 25th. We are still lining up some of the speakers, but they will include some familiar names like Tom Wheelwright, Doug Lodmell. We also have Richard Wilson of the Family Office Club this year, which should be fun, and just a few other people that I'm still trying to get some confirmations on. But at any rate, the big thing about these things is the ability to meet one another. I cannot emphasize how powerful that has been in our first two meetups. And there is literally, I don't know anybody who I've met who's not said that they thought it was definitely worth it. And if you didn't think it was worth it, let me know. Shoot me an email. But the value in getting to know each other in this tribe setting is just unbelievable. So at any rate, keep an eye out for that, and hopefully we'll see you in Arizona on April 24th and 25th. Also, my wife will be attending again, for those of you who thought she was more interesting than me, which is probably reasonable. Now, as for today's topic, let me tell you this. People send me real estate deals to look at all the time. And if you listen to me, you know that there's no point in doing so, right? Because I get it. People are trying to get an opinion on whether or not they should invest. The answer is I don't know, right? Usually there's some glossy executive summary showing nice pictures and impressive proforma numbers and all of that. And I don't even look at it. And you know why? Because I don't recognize the name of the group, right? And so everybody asks, well, what do you think, Buck? And I just write the same thing, which is simply, I don't know these people, so I can't comment. You see, I've talked about this before. I'll talk about it again, but real estate is not like buying stock. If I buy Apple stock, which I don't, and if I buy it from E-Trade, it's the same stock that you might buy from Ameritrade or that somebody else might buy from their particular brokerage. You don't have to worry that you aren't getting the same stock. No matter where you buy Apple, it will perform the same. And therefore, you have exposure to this stock called Apple. And so you don't have to worry about it. Now, real estate is different. Every property in which you invest is unique. Furthermore, the performance of the asset is highly dependent not only on the actual intrinsic nature of the property of itself, but also on who is operating it, right? The same asset in two different sets of hands will almost certainly, whether it's good and good, bad or bad, good, bad versus bad, will result in two different outcomes. It will not and cannot be exactly the same. Some operators are good and some are outright bad, but that's not even what I'm getting at. Well, think about it this way. If some operators are good and some are outright bad, it's probably a good idea to know who they are, right? To even have an idea that I think these guys are good, I think these guys are bad. And that may seem obvious, but how many people out there do you know that blindly invest in real estate through various online platforms where they have zero clue about the operator? All they're looking at is you get these things in the email. It says 15% annualized return, 15% IRR. and then all of a sudden people start throwing in money because they want exposure to real estate, apparently. Now, the platforms get paid to bring money to the deal. That's what they do. That's what these online platforms do. Why do people trust these platforms so much that they're willing to put thousands of dollars behind it and get exposure to quote unquote real estate? Is it because they have nice looking websites? Is that it? Is it because they sound official? Because they have a platform? Well, it must be real. And, what's real estate? It's real estate. I'm getting exposure to real estate, right? That's what people think. And people kind of, behave in a certain way that they're used to, which is if I buy Apple stock here or there, it's still Apple stock. Well, real estate is not the same. You see, apart from being good or bad, real estate operators typically have different business models as well. A few weeks back, you heard Dante Andrade, who's my colleague and partner in Dallas, in Turo, and we talked about the hybrid, value add cash flow model. Now, that's a very, very different model from what my partners at Western Wealth Capital do. Their entire focus is on the creation of value and equity for velocity and to get a big bump at exit, get your money back in your hands quickly, etc. So how do you decide with whom to invest? Okay, let's go back to that initial question. Let's reiterate that the idea that real estate is not a commodity and is highly dependent on people. Real estate is a people business. And that being the case, my general rule of thumb is to begin with a simple concept, which I know that I believe in, which is to know, like, and trust the people with whom you do business. That's what I spend most of my time doing these days, and that's with reference to Investor Club and everything that we do in there. Of course, liking and trusting is only part of it. It's really only part of it, right? I like and trust many people with whom I would never trust my money. I like and trust my mother, but I would never let my mother invest my money. You also have to make a judgment on, some expertise or somebody's competence in a particular area. Now, how do you do that? It's not an easy thing, right? Well, one simple way to do it, one fairly rudimentary way to do it, I should say, is look at the company's track record, right? So if you know, like, and trust a group and they have a stellar track record, you can at least start looking at proformas and taking them seriously because maybe they've met those proformas before. Maybe they've exceeded those proformas before. Maybe they haven't. Who knows? But at least you've got a chance to take a look, right? Because the reality is that anyone can make a proforma look good. Some glossy paper, Excel worksheets. Man, you can make a swampland in Florida look good. But every opportunity is not good, and most won't achieve proforma, especially in a market like we are in today. Now, going back to my partners at Western Wealth Capital. Now, listen, I won't pretend that I am not biased at all. Apart from being a partner of Wealth Formula, Western Wealth is. Western Wealth is a company that I have personally invested hundreds of thousands of my own dollars in. And perhaps more illustrative or demonstrative or whatever word you like, I have invested just as much of my 80-year-old dad's money in these deals. Now, I don't take that lightly, as you can imagine, but I know, like, and trust these guys. I know their track record. I know them at a very granular level. Western Wealth Capital has become a big part of my personal financial plan, right? My personal investment philosophy. They play a big role in that. And they are people that I know very well and trust. I really, really trust them very much. And you look at the model and it's unbelievable. Tim McCleary, whom, if you are an Investor Club, you probably already know Tim, but he is a big part of the Wealth Formula machine. He's also a very good friend of mine. He's become like a brother, and we will have a conversation with him right after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is my very good friend, partner, Tim McCleary from Western Wealth Capital. Tim has been involved with the financial services and real estate industries for 25 years before joining Western Wealth Capital. His resume is extensive, including oversight of more than $1 billion in assets at TD Bank Financial Group, and that was, of course, before our current run at Western Wealth. Now he is Vice President of Investor Relations at Western Wealth Capital, and he is obviously, the face that many of you who have been in Investor Club already have seen and met in person if you've come to our meetups in Phoenix and Houston. And of course, he'll be in the next one as well. Tim, welcome to Wealth Formula Podcast, man.
Yeah, thank you, Buck.
So, obviously, we've been talking within Investor Club and, pretty much every day with regards to properties that we're looking at, et cetera. But it's great to finally have you on the program to kind of, expose everybody who's not necessarily part of the Investor Club to what you guys are doing. So everyone, obviously people in the Investor Club already know at least you through the webinars. They may not have seen your pretty mug like you can on the video version here. But tell us a little bit about your past and, how you ultimately ended up from, these positions where more traditional financial markets into multifamily real estate.
Well, there's always a common theme, and I've always worked in an environment dealing with or connecting with people and institutions, anywhere from, as you mentioned, TD, which is institutional money management, business development leadership with major chartered financial banks. So again, the common denominator is the ability to connect with people. And my last position, so my last job, I was pretty darn comfortable, feet up, not being challenged, golfing a couple times a day, or a couple times a week, a day. Sometimes I would play.
You sound like our president.
Real comfortable. And actually, one of my good friends, a gentleman I used to play a little hockey with in the past, because that's what we do up here in the frozen tundra, is play a lot of hockey. He was the CFO of actually a very large local developer. And he had just joined this small little firm in Vancouver called Western Wealth Capital. And at the time, and I thought he was nuts. He went from a CFO of, again, one of the largest developers in Vancouver to this real estate company called Western Wealth Capital. And out of the blue, he gave me a call and introduced me to the CEO of Western Wealth Capital, Janet LePage. And that meeting, I basically sat there and said, I'll do whatever it takes to come and work with this organization. I just knew it was a rocket ship. She's an amazing lady. And then I met David Steele, the other co-GP, and that was 2.5 years ago. And I love every day, and I'm learning as we go as well too. And it's been a phenomenal ride, and I'm looking forward to the next 10 or 15 years.
So, obviously you're a smart guy and you're heavily involved with day-to-day operations, and you've got,
yes,
really your pulse on every part of this business. So, when you look at it from that perspective and what's going on in the economy, et cetera, why multifamily real estate right now?
Well, multifamily is kind of the darling play in that real estate asset class right now. More and more people and groups are running to this asset class, and there's a couple simple reasons. One, there's multifamily is a very low risk profile asset class. You look at the stock market and the fluctuations. I'm still a junkie. I look 3 or 4 times a day to see what the Dow and Nasdaq are doing, but basically the up and down of the Dow and Nasdaq. The market, that general market, that really depends on. I say it's moved from a fundamental market to an emotional driven market. Depends on tweets from certain people, then all of a sudden you'll see the market move one way or another.
Right.
Whereas multifamily is just it's boring. It's boring. It's a real boring asset class. But again, it's also something you can touch and feel. It's not emotionally driven. It's real property. It's something you can touch and feel. And then, also, plain and simple, people need a place to sleep, and multifamily provides that. There's 1,000 people moving to Texas a day. They need somewhere to sleep, and this is the reason why we love Dallas and Houston. There's more and more employers moving from the West Coast, to these states such as Florida and Texas and Arizona, and all those new workers need a place to sleep, and multifamily is provides them an affordable place to live. It's very much workforce housing, and that's what we look for. And then lastly, cash flow. I mean, you have a low risk profile asset class, and you're receiving a yield. I mean, it's basically the best of both worlds.
Yeah, I mean, I think the thing that you said that really resonates with me in general, and I've said it on this show a number of times recently, is that boring is good, right? Boring is good. I mean, this is, and take it from a serial entrepreneur type guy myself. I mean, I've chased enough shiny objects, and what's always amazing to me through that period over the last decade is that through everything that has failed and that has gone well, one thing just keeps doing well. It's boring, but it's called multifamily real estate, and that's been my experience. So again, just advice to just general advice, not financial advice. Don't stay away from something because it's boring. Don't go chasing things because they look bright and shiny, they look exciting. Because when they're exciting, there's inherently more risk. Boring is good. But let's talk about the Western Wealth Capital, because when you think about, the Western Wealth Capital model, it is it's quite opposite from some of the more boring ideas of when you think of REITs and stuff. It's actually pretty electric. I mean, Ken McElroy, who we had this meetup, as you recall, it was about a year ago in Phoenix, Scottsdale, and Ken was there, and Ken has known Dave Steele for a very long time, and they're friends. He listened to what Dave had to say, and he called it a, quote, money machine, right? And that's pretty high praise from a guy like Ken, and a lot of people trust Ken. I trust Ken. So what exactly is it that makes this machine what it is? I mean, it's annualized returns of 30% for investors through all divestments, and the speed at which things are working. What is it that makes this different? What is this money machine?
Well, firstly, I mean, that's super high praise from a guy like Ken. I mean, he's had massive success in this space, and as you mentioned, Dave Steele, or Co-GP, and Ken go way back. But that's huge praise from Ken, and that was fantastic when he did say that. Our model is pretty simple. What, Buck, really what it comes down to is execution of our plan. I'm a big believer in, you may have the best business plan on the planet, the best widget, gadget, whatever it is, but if you can't execute, guess what? It's useless. Mm-hmm. And our system, our process is repeatable, it's scalable. We execute on day one. Day one of takeover, when we take over a property. But before we take over a property, we already know what color we're going to paint the building. We know what the pool furniture is going in. We know what the monument sign is going to look like. The landscaping's taken care of. The leasing office is basically going to be remodeled as well on day one. We're putting flyers under the doors of the tenants, and we're saying, hey, do you want an in-suite washer and dryer? All the statistics that we read, that was the number one ask from tenants, is an actual in-suite washer and dryer. And it's mind-blowing to me that property owners out there that have pre-plumbed washer and dryers, but actually don't put washer and dryers in. Right. We simplistically throw a flyer on the door and said, if you would like an in-suite washer and dryer, for an extra $40 or $50 a month, just let us know. We'll install it. And on Tuesday, you'll have a washer and dryer. The balance of the month, no charge. But, as of the next month, there'll be a $40 or $50 charge. And what you got to look at is that installation of that washer and dryer for $40 or $50 a month based on a cap rate. It works out about an increase in equity on a per door basis of about $10,000. And again, like you said, it comes down to just simple math. And then, we throw in our Gold Star renovations where, we can turn a unit in about, 8 days at a cost of about $6,250 to turn that. And, if we're charging $125 for that Gold Star renovation, based on a certain cap rate, Buck, again, that per door, equity valuation has gone up by $30,000. So it really, what it comes down to is simplistically math and the ability to execute. And that's something that we're good at both.
Yeah. The way I think about it, and tell me what you think of this analogy, because, listen, at the end of the day, value add real estate is not a new concept. There's a lot of operators out there doing it. They've been doing it for a long time. But to me, what the difference when I look at it is that most value add operators, and I'm talking about even, a lot of well-known ones, they're really operating at a boutique type level of business, right? I mean, they're sort of like the if you look at it in terms of restaurants, they're the cafe around the corner run by the mom and pop. And, they've got an idea and they run it well. They get some good stuff going on. They get nice ingredients. But the reality is they may not be running it as efficiently. They may not be running it as quickly and as profitably as it can be. What's remarkable to me when I look at what you guys have put together there is you've got effectively a McDonaldization, right? Like you've taken something, a substrate like apartment buildings, $25, $30 million, $70 million apartment buildings, and commoditized the turning of those in such a manner that it literally reminds me of a McDonald's type, or some kind of industrial boom, 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 get it done kind of thing. And whereas you might think, well, that's not going to result in as good a product. The reality is the repetition, the repeating the same thing over, having the same type of, operations over and over make you better and better and faster. And that I just don't see anywhere else. And I'm curious kind of if that's the same, what you see as the difference from others.
Yeah, it's we're constantly working on our processes, and you said it. It's repeatable and scalable, and then you can call it the McDonald'sism theory, but that's what drives us very much. And again, it does come down to execution, as you mentioned. There's a lot of syndicators out there that really say they're in our space or in the value add space, but they really don't spend that equity. They don't have that team in place that can actually execute. And that's one thing that's different about Western Wealth Capital is Janet and Dave do spend the money. We do have the right people in all of the asset locations that we are situated. And we're not happy with 6 out of 10. We live in a world where 10 out of 10 makes sense.
The other part that I think is really different is speed, right?
Correct.
Because, and again, from the standpoint of a guy who's interested in looking at things from a mathematical way. I mean, I like equations. I like things that have definitive, ways of looking at things. The one thing that people don't usually think about is speed, right? So you're going to do this at scale. You're going to turn this. You're going to get so much, increase in apartments and net operating income. But if you can contract the amount of time it takes to get there, you've effectively doubled your return. And that presumably is that's why you're getting the kind of returns you are. I mean, don't you think that speed is probably the variable that is most unique to the model?
Very much so. And I mean, how I look at that is we're a very conservative organization. All of our models they're cookie cutter. We're big believers in under promising and over delivering. Janet's math background.
She's a computer scientist.
She's a computer scientist by trade. Exactly. It's very math based. We have a WOW program. We had a WOW 1.0. We now have a WOW 2.0. But so what we're trying to do is just increase the speed of how quick we execute. And really what that comes down to, Buck, is for our investors is we're de-risking their investment from day one. We're increasing the value of that property so quickly that we are literally moving the cap rate from, let's say, a buy of 5 to 6 or 6.5 because of the execution of our business plan.
There's another part of that speed, and that's really pertinent to investors, and that is the idea of getting your money out of the deal. We always talk about in terms of the wealth formula. Mass times velocity times leverage. So velocity being like how quickly you get your money back out of a deal. One of the things I think is really interesting is the use of the supplemental loan program. Can you explain kind of how that works to people who don't know about it, and some of the advantages of doing that?
I mean, just very high level, when we buy a property, and we're going to use some round assumption numbers here, but let's say we buy a building for $20 million, we're typically using agency debt. The lender will actually provide us with a loan, 100% valuation of that property, loan to cost. So let's say the full $20 million. However, they will not, of course, fund us that full amount. Typically it ranges anywhere from, based on our model, 65 to up to 72%, of that LTC. And then as we create that value in that property, as we execute, and at the speed that we do, we are creating value quickly. We can go back after 12 months to our lender, and instead of doing a whole refinance package, which typically is quite expensive, we just go back and have our lender revisit the financials and basically pull a supplementary. So again, if that building goes from 20 million to 25 million, they will release 70, anywhere between 65 to 70, 72% of that additional $5 million in equity that we've created. What we do with that equity, well, we give it back to our investors. So our whole model is, and we've again under promised and over delivered here, but what we proforma is to return 50% of the investor's equity between a 24 to 36 month period, and then another 25%, so up to 75% between a 36 and 48 month period, and then up to 100% of their original equity back between a 48 and 60 month period. So they still retain their original percentage ownership in the building, the same number of units. However, as you just mentioned, Buck, what it does do is it puts money back into their pocket a lot quicker. They can, in turn, reinvest that into something else. And, again, the velocity of their money and the velocity of returns are definitely increasing.
That's really the key, is that the cash out refi model is, again, it's nothing new. Just like value add, it's nothing new, but usually you don't see it for about 5 years. And then you get, maybe you get a refi and hopefully you get your capital back out of the deal, and you've got, what we call infinite returns. But in what we're talking about here is really unique, because I know you mentioned 24 to 36 months. Just looking over the history, it looks like the average has been about 18 months, where investors are getting about 50% of their capital back. And then, a year later or whatever, they're getting, over the next year or two, they're getting the rest of it back. By the way, the model does not allow for a split until then. So in other words, the operator's not getting paid, any part of the equity until 100% of capital is returned. But what that does is it allows you to take, not wait 4 years, but wait, say maybe it's 18 months, 24 months, whatever. And if you invested 100 grand, take 50 grand back and put it into something else. Now you've got an opportunity to make money in two places at the same time with the same capital. And that's where the numbers really go off the hook, right? That is kind of the thing. And then, as Tim mentioned, it's also a de-risking. So tell us a little bit about, like, kind of your track record in terms of doing this kind of stuff.
Well, I mean, I'll tell you a little story about one of our investors. He is a he. He started with us. It's actually 5 years ago now. We're a 6-year-old company, so he did a little, but it took about a year of research for him to give us his first dollar. But so it's been about 5 years ago. He started investing with us. He spread $750,000, throughout a couple of deals, and
through every deal, right? Wasn't it, or something?
Well, yeah, he was. He started coming in, and we do the dip your toe in with a certain amount, and then the investment level got a little bit larger, and so his total investment, with Western Wealth Capital was $750,000, and it's funny. He comes to all of our wine and cheeses, and he basically said, "I'm not going to give you any more money. I'm done. But I promise you this: what I'm going to do is every single penny that you give me, I'm going to reinvest it." So, through all of our refis, our divestments, dispositions, which we've had 31 to date. So every penny he's given back to us, his actually equity level and ownership of properties with us is just now under $4 million.
So $750,000 total investment over, spread over several deals over the last 5 years is now worth about $4 million.
And he's just continuing to roll it. Yeah, that's all he's doing. Actually, I should ask him. I should have to pay him, but he loves to talk. I should take him on tour with me.
I want to get him on the podcast. That comes out to roughly an 89% annualized return on capital.
Yeah,
that is insane, right?
Quite a run. Yes.
So, okay. Well, what's interesting to me is that with these kinds of returns, people assume there's got to be a lot of risk, right? I mean, how do you get 30% annualized returns? How do you get 89? How does this guy get 89% annualized return? But in fact, the two elements, and you've alluded to this before, that tend to theoretically make these opportunities even more stable than most offerings is that first, you've obviously got a heavy capital expenditure budget, because this whole thing is about turning really neglected properties into really high quality properties. And if anybody's ever been on a Western Wealth tour, you'll see it's just amazing. But so it's a huge, it's a big investment up front that's raised from the capital, from the equity. But one of the beautiful things about that is, hey, we're not going to just try to expect that we're going to generate all this income from the property, right? And that creates this level of cash that's sitting up front. That is one thing that, in my mind, significantly de-risks the opportunities. Is that there's a huge capital stack sitting there waiting, but then there's also the other idea that whereas we're driving equity into this and we're making a profit, hopefully by driving cap rates up dynamically in real time. You're essentially creating, you're like, as you called it, de-risking the property, right? I mean, those are the two main elements. Is that kind of how you see it in terms of mitigating risk?
Yeah, 100%. I mean, not only mitigating risk, but also, it comes to returns. When we model a property, and then when we send our basic OM executive summaries out, we're not showing 30% returns. And that's what we've actually achieved. In our past, we've had 31 dispositions for an average hold period, 29 months, for an average return of 30% annualized. So we're not showing that. What we're basing our math typically is working out to between 17 to 20% annualized returns based on our property.
And the
very
proformas?
Conservative model. Sorry?
On the proformas.
On the proformas, exactly. Yeah. When we have a property with, say, 200 units, we're not saying we're going to execute our value add proposition on 80%, 85%. We're saying we may do 60, 65%. And that's where we come up with these 17 to 20s, plus our refinance of 50, 75, and 100. But again, the whole goal bucket comes down to is, again, under promise and over deliver. And as well as you can under promise and over deliver, but you better be able to execute and the speed. And again, we're very good we're obsessed, actually. That's the word we use. Yeah. We're obsessed with execution.
Yeah. And that's pretty obvious. How big now, because we talked about how this has been a lightning bolt of a business in terms of growth. How much property is under management now?
We're just under 16,000 units.
Uh-huh. And then what does that come out to in dollars? Get it in front of
you? In dollar figure?
Putting you on the spot, but just to remember, it moves so quickly, right?
So last year we actually, 2018, we purchased 16 buildings. In 2019, we purchased 19 buildings. Our goal this year is 24. However, we do have, different sources of.
That's got to be $1 billion at least.
We're well over. We're over 2.2 billion.
2.2 billion. Got it.
Yes. Yeah.
Okay. So we've got all this good stuff going on, and there's skeptics out there, and for good reason, that say, well, gosh, what are you going to do when the market changes? I mean, we talked about some of the things that you can do to de-risk that, you're decompressing your own cap rates by creating this dynamic, driving of net operating income. But what happens in that scenario? And typically, a cycle like that might last a couple years. If you have a situation where you've decompressed cap rates, and you're certainly in a position to be safe because you got about a bunch of money in the bank, you've driven up your income. But then what do you do then to try to maximize yield? Do you just, hold on to the property and wait for better days, or what do you do?
Yeah, I guess the worst case scenario is as you mentioned, you sit in cash flow. Again, we're a bit unique. We don't have to borrow our CapEx. We raise our CapEx. So, we'll right. sit on a whack of cash. If required, we can still continue implementing our value add program because, again, in a crunch period of time, try and get money from a bank or agency, you can't. So right. Other syndicators just have to stop. We raise that CapEx, so we can keep going if we want. But worst case scenario is we sit in cash flow. But we also, what we look at is in the markets that we deal is, where we have assets, or the markets that we really like is, we take a real look at the A type of properties existing or being built. And, we love buying by a C or C plus type of building right beside an A because, the individual is at, that's paying $2,250 a month for an 800 square foot A type of property. When that market does change, our $1,550, 1,100 square foot newly renovated unit plus completely upgraded amenities is going to look fantastic. It's going to save that individual $700 a month. So, again, it comes down to de-risking your investment. And, that's one of the aspects that we look at is that A type of property in the area. But again, worst case scenario is, we stuff it full and we cash flow.
Yeah. So, just to be clear, we're talking about C plus, probably, what you guys call C. It's probably more C plus.
Yes.
C plus, moving it up to like a B plus in a, like near an A area or something like that is effectively the idea. Speaking of the markets, though, one of the things that I think is how, when you right now, I've been saying that one of the most critical aspects of buying real estate right now is picking the markets, because when times when things are hot and things are markets are flying, that's when you get like these you get these tertiary markets that people start chasing yield where in situations where, if the market turns, there's really no natural growth there. There's no real job, there's not new industry. There's not that. I mean, how much of that goes into market selection? Can you kind of talk about your process there?
Yeah, you nailed it, Buck. We're seeing a lot of other firms, chasing yield, chasing returns. There's a lot of equity out there, but there's also a lot of kind of startup syndicators trying to make a mark, and so they're trying to chase returns. And what they don't see, and what we see with over 100 transactions, they don't see the deal flow that we see. We're seeing 22 to 30 deals in about 12 different cities a week. But we see other firms, buying in those tertiary markets, and that, we'll never do that. So when the market does correct, places such as, Dallas, Houston, Atlanta, Phoenix, these markets that are in your top 5 to 10 type markets for economic growth, when there is a correction, yeah, they may correct a little bit. However, if you're buying in a market that right now is ranked number 15, 16, 17, and it's there now just because it's kind of, tertiary market is a bit of a darling. When the market does turn, guess what's going to happen? It's going to go from 15, 16 to 30, 31. Our philosophy isn't, we don't buy and cross our fingers and hope that the market goes up.
Right.
That is just not our value proposition. Again, we're going to markets that are stable, strong economic growth. There's companies moving there. And then basically it comes down to executing your model.
Yeah. And, and I think that's an important thing. There is this constant sort of tension between finding yield, but also staying within markets that have strong job growth and, population growth. And so the nice thing about, major markets, and I know you're in Dallas and, Houston and Phoenix and some of these markets that are, they're not New York and LA, but on the other hand, they're growing like gangbusters. They, at the end of the day, even if you have a change in sort of the overall real estate market, you have this other opposing force, which is the growth in population. And that isn't going to, presumably that's not going to stop. People are moving there for a reason. Tough economic times are only going to make them move there even more.
I had just a funny story, Buck. I was in Calgary last week, which is a part of Canada, talking to a farmer last week, and he explained it this way. He said, Tim, he says, I have a chicken, and I want to make sure my chicken is laying eggs. But in the long run, I want to make sure my chicken's safe at the end of the day. And it's so simple, and you're giggling, but really that's what it comes down to.
No, I love it. I love it from a chicken farmer in Calgary.
A great analogy, right? I want my eggs, but I want to make sure you preserve my chicken, and that's definitely Western.
That's called capital preservation, which is for a group that's plugging out those kinds of numbers. Capital preservation, being part of the equation is a nice relief as well. So tell me, what's the plan again for this year, 2020? Western Wealth Capital. What markets are we looking at? What's the what's the goal?
Well, we're currently in 5 markets, as discussed: San Antonio, Dallas, Houston, Atlanta, second largest owner-operator in Phoenix. There's about 12 cities that, we follow very closely. Our goal for 2020 is to add 2 new cities. So that means not to have assets in 5, to have them in 7. The type of markets we're looking at is, we're in Nevada. We're looking in Nevada. So we're looking at Vegas. We're looking in Denver, of course, at Denver, Florida, many centers in Florida as well too. Washington State, Seattle, Portland, and Nashville as well too. So we have a 6-member acquisition team, and we always joke. I'm not sure who lives in airports more, them or myself, but we're kicking a lot of tires, but the goal is at the end of the year to be in two new cities. We just don't move in a city unprepared. We do a lot of homework. We do a lot of back check. We don't, we actually, before we move in a city, we don't want to buy one building. We're going to go in and typically buy 3 buildings. We want to get, we want to have 1,000 to 1,500 units.
Well, that's part of the exit plan too, right?
Of course.
I mean, and that's one of the things that I think is important too. One of the reasons that you end up getting paid more for these is you're not selling one building at a time. You're wrapping it up to like 7 or 8 buildings at a time and selling it at a premium to a big, institutional buyer.
Yeah, no, yeah. And for numbers, we're probably looking at, again, 1 a month. So probably 12 deals this year. So for on a deal flow perspective. So another ambitious goal.
I'm just curious one thing, and I don't know how much you've actually looked into it, but it's funny that you mentioned Vegas. But I brought that up too because I remember the economist that we had at our last meetup, and the growth in just in people moving into Vegas is insane, right? But the question is it real this time, right? Because
it is. I mean, you look at the jobs. I believe not that long ago, over 60% was, in that hospitality sector. I believe that's under 40% now. Yeah. So that just shows that there's other types of opportunity now in Las Vegas, and it's not solely dependent on the casinos. They're and again, it's another state
like
that is
just one of those things where it's ripe, right? I mean, it's like, what's the difference between living in a climate-wise, say Las Vegas, Nevada, and Phoenix, Arizona, right? I mean, it's not, and people are, and Phoenix is growing very quickly, and then Vegas, all of a sudden now they've got they're going to have a football team, they have an NHL team. It's starting to seem like a normal thing to live in Las Vegas.
It is. It's like anywhere, Buck. It's any state or city you live in. There's tremendous opportunity in great pockets. I know a lot of people that live in Vegas, and you joke. The first question is about the Strip, and it's like any city you live in. They all just kind of chuckle and say, we may go to the Strip once a quarter. It's like me going downtown for dinner with my family. It's
right.
It's same concept.
Well, Timmy, I don't want to keep you too long. It has been great to have you on the show. And for those of you who want more of Tim, well, you can read about him at the Western Wealth Capital website. Otherwise, you can join Investor Club if you are an accredited investor, and that's where Tim frequently does webinars for us. Tim, again, I want to thank you. It's great to have you on the show finally.
Thank you, Buck. I really appreciate it. Thank you so much.
We'll be right back. Welcome back to the show, everyone. I hope you enjoyed the conversation. If you want to learn more about Western Wealth Capital, make sure to sign up for Investor Club at wealthformula.com. That is, of course, if you are an accredited investor, which all this stuff, frankly, unfortunately for most, it requires. Now, one thing you might want to do for your own edification after listening to this podcast is go back and listen to the one I did with Dante Andrade on our hybrid value add cash flow model. The reality is there's no right or wrong to this stuff, but there are differences in the various models, and it's all about educating yourself. Everyone should have a good sense of not only their personal financial philosophies and goals, but also, what kinds of stuff is out there that fits into those goals. Now, Western Wealth is not a cash flow model. We emphasize that all the time, but it is a huge growth model, as you can imagine. If you are a high-paid professional, you may ask yourself whether it is really that important for you to have a cash flow model right now. Admittedly, I used to think that it was all about cash flow, right? Even if you read 7 Secrets of Eternal Wealth, I'm like, it's cash flow, cash flow, cash flow. But the reality is that not everybody needs it right now. If you're a high-paid professional, say you're a doctor, making $300,000-$400,000 a year, and you put $100,000 into a deal that's putting out 10% per year, and all of a sudden you've got an extra 10 grand per year coming in, or if you did 50 grand for the investment, you get an extra 5 grand in per year. Is that making a huge difference in your life today? Maybe, maybe not. But most of the time, what I hear from the high-paid professionals is that no, it doesn't really move the dial that much. So an alternative to that is to just create growth in that capital. And perhaps, you take that $50,000 today and you keep, investing it for growth, and maybe it turns into $500,000 over the next few years. And then you convert it into a stream for cash flow, and that actually would make potentially a material difference. Now, from Tim's story, you heard the thing about the guy who invested $750K totals, comes out with $4 million in principal. It sure seems like it's possible, right? So anyway, I don't want to tell you how to invest, but these are the kinds of things that you ought to be thinking about as you listen to these podcasts. There is no one right business model. There is no one right way to invest. However, I will tell you again and emphasize this again, there are right and wrong operators. So get some in your bullpen, so to speak, the ones that like, and trust, and then make rational decisions about their models. Now, that's not financial advice by any means. It's just common sense. Anyway, that is it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.